Something terrifying just happened, and almost nobody noticed. BlackRock, the biggest money manager on the planet, just sold $175 million worth of Bitcoin. And this is the third time they've done this in just 8 weeks. Why would the same company that told everyone to buy Bitcoin suddenly be dumping it? Here's what's even stranger. They're not alone. Other massive institutions are quietly selling too, following the exact same pattern we saw right before the 2018 crash and the 2022 meltdown that destroyed 70% of Bitcoin's value. If you're holding crypto right now, you need to see this. Before you do anything else, hit that subscribe button and turn on notifications, because this is the kind of truth that doesn't get talked about on mainstream finance channels. If this video helps you understand what's really happening, smash the like button. It pushes this message to more people who desperately need to see it. Stay with me for the next few minutes because I'm going to show you the exact pattern BlackRock is using, why the timing is so suspicious, and what it means for your money. This isn't theory. This is happening right now. Let's follow the evidence. BlackRock just dumped $175 million worth of Bitcoin. That number alone sounds big, but the real story is in the details. The sale happened on a Tuesday morning, right when liquidity was thin and trading volume low. That's unusual. Large institutions normally spread big sales across days to avoid crashing the price. They don't dump in one move. But BlackRock did exactly that. The timing raises flags. Bitcoin was stable, not spiking. There was no obvious profit target hit, no regulatory announcement, no public reason to exit fast. Compare this to how BlackRock operates in equities or bonds. Always smooth, always calculated. This felt different, rushed, even more suspicious. The sale happened through multiple wallets, not their main custody address. That's a pattern we saw in 2018 before the long crypto winter began. Back then, institutions quietly moved coins before selling, trying to hide the size of their exit. History doesn't repeat, but it echoes. And right now, that echo is getting louder. This wasn't BlackRock's first exit. It's the third in 8 weeks. The pattern is what matters. First sale, $89 million, 7 weeks ago. Quiet, barely noticed. Second sale, $112 million, 3 weeks later. A few headlines, but dismissed as rebalancing. Now this, $175 million, the size is escalating. The intervals are shortening. That's not random profit taking, that's a sequence. Think of it like a pilot dumping fuel before an emergency landing. First a little, then more, then everything. Each move tests the market's reaction without triggering panic. Strategic repositioning looks measured and slow. This rhythm feels different, accelerating, not steady. Compare this to 2017 when institutions entered Bitcoin gradually over months. They built positions carefully. Now they're unwinding the same way, but in reverse and faster. The question nobody's answering, what did BlackRock see 8 weeks ago that started this sequence? Markets don't reward early exits unless something ugly is coming. And right now, BlackRock is already 3 steps ahead of everyone else. History offers 2 clear warnings, 2018 and 2022. Both times, Bitcoin crashed over 70%. Both times, institutions exited quietly first. In late 2017, big funds started trimming Bitcoin positions while retail investors were still buying. The public didn't notice until months later when prices collapsed. Same pattern in 2022. Major holders reduced exposure in January and February, but the real crash came in May and June. By then, institutions were already out. Retail held the bag. Today's pattern matches both episodes. BlackRock's 3-step exit mirrors the gradual institutional retreat we saw before. The difference? It's happening faster now. What took 5 months in 2018 is happening in 8 weeks today. Think of it like insiders leaving a building before the alarm sounds. They don't run. They walk calmly toward the exit while everyone else stays inside. The alarm hasn't sounded yet for Bitcoin, but the smart money is already near the door. The question is simple. Why are they leaving now? The timing of BlackRock's Bitcoin sales overlaps with something bigger. Credit markets are cracking. Credit spreads measure risk in lending. When they widen, it means lenders are scared. Right now, U.S. corporate credit spreads just hit 12 basis points above normal. London's sitting at 18. Those numbers haven't been this high since March 2023, right before 3 regional banks collapsed. BlackRock manages trillions in bonds and credit. They see lending stress before anyone else. When credit tightens, risky assets get sold first. Bitcoin sits at the top of that list. The pattern is clear. 8 weeks ago, credit spreads started rising quietly. That same week, BlackRock made their first Bitcoin sale. Coincidence? Unlikely. Think of it like a smoke detector going off in one room while everyone's still partying in another. BlackRock smelled smoke. What makes this terrifying is the connection. If credit markets keep breaking, institutions will need cash fast. And Bitcoin, despite all its promise, becomes the first thing they'll dump. On-chain data reveals something disturbing. BlackRock isn't moving alone. Blockchain tracking shows Bitcoin flowing out of institutional wallets across multiple firms during the same 8-week window. Fidelity moved $94 million. Grayscale reduced holdings by $130 million. Smaller funds followed. The exits aren't identical in size, but the timing matches too closely to ignore. This suggests coordination, not coincidence. Big institutions often share risk committees and client briefings. When one major player spots danger, others get the memo. It's like watching birds suddenly leave a tree before an earthquake. They're responding to the same signal humans can't detect yet. Compare this to 2021, when institutions bought Bitcoin together after Tesla's announcement. They moved as a group then too. Now they're exiting the same way, just quieter. The unanswered question, what signal triggered this coordinated retreat? Was it a private client report, a Federal Reserve warning shared behind closed doors, or simply BlackRock's risk models flashing red, prompting others to follow their lead? BlackRock doesn't guess. They know things we don't. With $10 trillion under management, they have access to data retail investors never see. Private economic forecasts, client redemption patterns, direct lines to central banks. Their risk models process thousands of signals daily. Inflation trends, currency stress, corporate earnings warnings, debt rollover schedules. Something in that data turned hostile 8 weeks ago. Maybe it's client withdrawals accelerating. When pension funds or sovereign wealth clients pull money, BlackRock needs liquid assets fast. Bitcoin converts to cash easier than real estate or private equity. Or perhaps their models see recession signals strengthening. During downturns, correlations break down. Assets that should be independent all fall together. Bitcoin, once called digital gold, dropped alongside stocks in 2022 when inflation spiked. Think of BlackRock as a seismograph detecting tremors before the earthquake. They're not panicking. They're repositioning based on probabilities we can't calculate. The terrifying part? They've been right before. And when BlackRock moves early, the crowd usually realizes too late why. All the threads connect to one conclusion. BlackRock sees a storm coming. The three escalating sales, the widening credit spreads, the coordinated institutional exits, the suspicious timing, none of this happens by accident. This is calculated risk reduction before a major event. History shows institutions don't exit winning positions unless they expect something worse ahead. Bitcoin's current price looks stable on the surface, but underneath, the foundation is cracking. When the largest asset manager on Earth reduces exposure 3 times in 8 weeks, that's not strategy. That's a warning. The pattern mirrors every major crypto crash. Quiet institutional retreat, while retail stays optimistic. The alarm hasn't sounded publicly yet. Media still talks about Bitcoin's potential, but the smart money is already moving toward the exits. What comes next depends on what BlackRock's models are detecting. Recession, banking stress, currency crisis? We don't know yet, but their actions suggest they're preparing for impact. And when BlackRock prepares, everyone else should be paying attention. The evidence is undeniable. BlackRock's $175 million Bitcoin sale isn't isolated. It's part of an accelerating exit pattern spanning 8 weeks, mirroring institutional retreats before 2018 and 2022's collapses. The timing aligns with credit market fractures not seen since banking stress last year. On-chain data reveals coordinated movement across multiple institutions, suggesting shared intelligence about approaching danger. BlackRock operates with information advantages we lack. Their models see economic tremors before earthquakes hit. History proves institutions don't abandon positions early unless catastrophe looms. The terrifying reality? This pattern has already begun. The question isn't if something breaks, but when, and whether retail investors recognize the warning before it's too late. The smart money has already answered.